Hey everybody, welcome to another edition of 5 Question Friday, where I do my best to answer 5 questions that you all have sent in. Here's what we've got in store for us today. We're going to, number one, we're going to look at what's called the Social Security break-even age and answer the question, have we been lied to about how that should be calculated? Question 2 is going to cover the 4% rule and whether, can we just start all over? If we're a couple of years into retirement, can we just say, I'm going to start all over as if I'm retiring today? Question 3 is, deals with whether an equal weight ETF for the S&P 500 would be a good move given high stock valuations today. Question 4 deals with Roth conversions once you're already in retirement and that 5-year rule, and will we get penalized if we spend the money, and how does that work, and we'll talk about it. And then the 5th question relates to my decision a number of years ago to move from 6 mutual funds down to about 3. It's really kind of 4 now. Why did I do that? Was it just to simplify what's going on there? So great questions. If you'd like to submit a question, just subscribe to the newsletter with the link below this video. It's free, goes out every Sunday morning, and you can just hit reply and ask away. I would love to hear from you. All right, so let's dive in. The first question comes from a viewer named Mike. I'm paraphrasing the question. And because what he did was he linked to another YouTube video from another YouTuber and with a one-word question, thoughts. You want to know my thought about this video. And I watched it, and I'm not going to link to it because I don't think it's worth linking to. I don't think it has value, so I'm not going to link to it. But I do think the topic is important. And effectively, what this video said was, we've been lied to. By the way, I have no idea who's lying to us, but someone out there is apparently lying to us about the Social Security break-even age and how that's calculated. What in the world are we talking about? Let me show you. I will link to everything I show you. As always, this is just an article about how to calculate the break-even age of Social Security, and this will explain how to do it and what that means if you're not familiar with it. But let me make this even a little bigger if I can. Here we go. They had just an assumption. Let's assume someone, if they took Social Security at 62, would get $1,400 a month. But if they waited to 70, it's 8 years, a long time to wait. But if you waited, you get $1,100 more. How should we think about that? And from a break-even age. And so what this article walks through is, okay, well, we first need to know the difference, $1,400 to $2,500. Well, that's $1,100. And then if we took it 62, $1,400 a month over 8 years, how much would we get? And that's what they calculate here, really easy math. You get just a little over $134,000. And so according to this article, the way you calculate your break-even is you take this 134 and you divide it by this 1,100, which they do right here, equals 122. So it would take about 122 months, we'll call it 10 years, to break even, to end up with as much money claiming at 62. If you just kept it and put it in the mattress, put it under the mattress, put it in a safety deposit box, after about age 80, you'd have the same amount of money, whether you got $1,400 a month starting at age 62, or you got $2,500 a month starting at age 70. Now, some of you already you're saying, well, wait a minute, Rob, I might invest that $1,400. I'm not going to put it under a mattress. I'm not going to stick it in a safe deposit box. I'm going to invest it. And that was the point of this video he emailed me, the viewer emailed me, and it's a perfectly legitimate question. What the YouTube video concluded was, depending on how much you might earn on this money, your break-even age wouldn't be around 80. It would probably be in your 90s. And most people won't live that long. So you won't live long enough to reach the break-even age. And therefore, this idea of delaying Social Security to your, say, 67, a full retirement age, or even 70 is just wrong. And we've been lied to. Again, I don't know the whole lied to. I think that's just to get people to click on the video. I'm not really sure. But there's a point there to be made. Now, I'm going to put aside for just a moment how we would calculate that. If we say, yeah, I'm going to invest this money. By the way, even if you spend it, it may mean you're simply taking less out of from your IRA, and so that money's being invested. So even if you spend the Social Security check, there's probably, if you take early, you're going to have more money invested. How can we factor that in to the equation? I'll show you how to do that. I'll give you a really easy tool you can use to do it. But we have to ask a more fundamental question, and that is, should we be calculating a break-even age? Is that how we should be thinking about when to claim Social Security? I can tell you that if I knew I was going to die 1 month after I started claiming Social Security at age 70, I would still wait until I was 70. I don't give a hooey about the break-even age. And hooey is a technical term. In any event, why? Well, in my case, I'm married. I'm the higher earner. That means my benefit is going to be higher. If I die first, my wife will get my benefit in place of her benefit, which is lower. And I want my benefit to be as high as possible so that if that happens, my wife gets that money. And so I won't claim until I'm 70. So at that point, I'm not even thinking about a break-even age. I'm just thinking about my specific set of circumstances and what makes sense for me in this case. And break-even age, regardless of how you calculate it, wouldn't help me. Now, you could be saying, well, that's great for you, Rob, but I'm single. Or I'm married, but I don't have to worry about that issue for whatever reason. Maybe you're the younger or the spouse who didn't earn as much. Maybe you're not the higher earning spouse. Or again, maybe you're single. So here are a couple things to think about. Let's start with someone who's single. A lot of the analysis goes like this. Yeah, I might not live into my 90s, but then again, I might. And I want to view Social Security as insurance against the possibility that I do live into my 90s. Who knows, mid-90s? Maybe I live to be 100. I get it. The odds aren't great that that will happen, but that's the case with all kinds of insurance. You know, you have homeowners insurance, but it's unlikely that your house is going to burn down. That's sort of the idea behind insurance. And so I think a lot of people should look at Social Security that way. Again, we're assuming you have the financial means to delay claiming Social Security. And if you're looking at it as longevity insurance, again, the break-even age is irrelevant no matter how you calculate it. And if we go back to a married couple, for the spouse that is the lower earner, we often conclude that they should take early. So no one's lying to us about waiting till 70. In fact, a lot of the calculators will say for a married couple, the lower earning spouse should take early, and exactly when can depend on how you calculate it. But it's often right when you're able to at 62, and the higher earner spouse should wait until they're 70, again, if the couple is able to do that. And the break-even age has got nothing to do with any of this. Now, I suppose someone could say, well, I appreciate all that, Rob, but I don't need longevity insurance. I'm single. I don't need longevity insurance. I could live to be 120 and I'd be fine with or without a higher benefit from Social Security. So the thing I would say there is, number one, well, good for you. And honestly, your decision probably doesn't much matter. I mean, you don't have to worry about these issues. If you want to use a break-even age to think about it, that's certainly sensible. And you might even want to think about what your money would earn if you invested it because you claimed early rather than, say, waiting until 70. So what can we use there? I like this tool, and it's free. Open Social Security. Again, I'll link to this. And when you come to this site, this is what it looks like. And you notice I've got this little button here, checkbox. If I check it, it gives me some more options. And one of them is the discount rate. So this idea of using a discount rate, which is the same thing as saying this is what my money would earn if I invested it, because I claimed early. This is nothing new, right? No one's been lying to us. This is not some secret hidden from regular folk. It's a kind of analysis that folks have done for a very long time. And if we scroll down here, you can see this tool, by the way, was developed by Mike Piper. He's a CPA, an acquaintance of mine. He's been on the show. You can search the YouTube channel, Mike Piper, and you'll find his video. We talked a lot about this tool. And you can put whatever discount rate you want in here. Now, he has 2.24. He uses the yield on the 20-year tips. And if you click this link, it opens up an article, this opens up the current yield. But he also has an article, here it is, where he describes his thinking behind this. I like using the tips yield because the increases in Social Security are guaranteed increases, right? There's no risk there. We know what they're going to be. You can calculate it. And so I don't want to compare a risky investment like stocks with a risk-free, I'll call it investment in air quotes, an investment of increases in Social Security benefits. I just don't think that makes sense. So if you were to use something like 2.24, that would increase the break-even rate above 80. You can run this test for yourself with your actual Social Security amounts here. Certainly, if you put in here, say, I don't know, 5%, you're going to probably be in your 90s. Certainly, if you put, I'll just make up some numbers, 7%, you're going to be in your 90s. The thing I would caution you, though, is to say, well, stocks over the long run have earned 10%, and that's how I'm going to invest the money. And even if you factor in inflation, it's probably 7%, so I'll just use that number. The thing you have to keep in mind is that the real key is the difference between, say, claiming at 62 and waiting, let's say you wait till 67 or 70. It's that 5 to 8 year period that really matters. And we don't know what the returns are going to be during that period where you either delay taking Social Security or you don't. That's what really matters. And I personally, when comparing a risk-free investment, I wouldn't compare it to a very risky investment and run the calculations. That's just my take. But again, I think the real key is that most people don't even need to really worry about a Social Security, break-even age at all, in my humble opinion. So there you go. All right, question number 2. Is it okay to restart the 4% rule if the market goes up in early retirement? So that's Andrew's question. And he gave me a hypothetical. Imagine you start with $1 million. You've got your $40,000 if you're going to follow the 4% rule, and you're spending it and you're having a good retirement. But at the end of the first year, maybe you're 96,000 after we subtract the 40. Maybe it's up to 1.1 million. Maybe the market went crazy. It's 1.2 million. Can you just say, rather than taking the measly 2 or 3% inflation adjustment, I think I'll start all over. I'll just pretend I'm retiring today and I've got 1.2 million, and I'll multiply that against 4%. So there's 2 answers to that question. There's the theoretical sort of math answer. And the math answer is sure. I mean, if we're still assuming a 30-year retirement, or maybe now a 29-year retirement, the 4% rule has historically always worked. It's always survived, at least in the U.S. markets and U.S. inflation. And so, yeah, you could do it. Now, I will say that the higher the market goes, if we look back at history, the higher the market, and by that I mean basically the price to earnings, the valuation of the market, and they typically use what's called the CAPE, the cyclically adjusted PE. It looks at earnings from the market over a 10-year period and calculates the PE using that. The higher that number is, the lower the safe withdrawal rate is. All right, now that's looking historically. So we've got the benefit of hindsight. We actually run the numbers, and that's what we found. They're inversely proportional. So the higher the CAPE, the lower the safe withdrawal rate. And if the market's really doing bad, it means the CAPE's lower. Well, the safe withdrawal rate's much higher. In fact, I can show it to you. I'll link to this. But this is from Michael Kitces. This is all the way back from 2008. And he charts the starting PE with the real returns of a 60-40 portfolio. And you can see the red line is the starting PE, and the blue line is the starting real returns. And when the starting PE 10 is low, the real returns are high. When the starting PE is high, the low returns are low. And he has a lot of other charts in here. This is, in effect, almost the same chart, except he's charting the starting PE with the safe withdrawal rate. So again, theoretically, the 4% rule should always work. However, the higher the CAPE PE, I would argue you do run the risk that at some point maybe the 4% rule doesn't work, right? That's always possible. Now, of course, Kitz's article was focused on the S&P 500. You may have a much more diversified portfolio, and so maybe you view the risks as not as great. I'm just sharing you the information. But the other thing I would say is, if you restart the 4% rule or whatever withdrawal strategy you have, because the market's up, what are you going to do when it falls by 20 or 30%? Now, your answer might be, yeah, I'll probably cut back. And that's fine. That's a reasonable, I think, response to the market as someone in retirement. But then it raises the bigger question, should you really be following the 4% rule for determining your withdrawals? Maybe there's just a better approach, like using tools like Empower, Bolden, or Projection Lab, coming up with what you find to be a satisfactory sort of chance of success, and keeping track of that every year, maybe making some small adjustments to your spending as necessary to feel comfortable. I think that's very reasonable. That might just be a better approach than trying to restart the 4% rule or some other withdrawal strategy. Just a thought, but I think it's a great question. Yeah, that's my take on it. All right, question number 3 comes from Ken. He says, I'm nervous about the run-up in AI, artificial intelligence stocks. Could it be a good idea to consider diversifying from VTI, which is a Vanguard Total U.S. stock ETF, to an equal-weighted index fund like Invesco S&P Equal Weight ETF? Great question. Let's make sure we all know what, we're on the same page here. Let me show them to you. So this is in Morningstar. This is VTI. You can tell from this blue box that means its average company is a large company, and it's a blend of growth and value. So you can think of value stocks as like banks and utilities. Growth stocks are all the high-flying tech companies, among other things. And the blend is sort of just a mix of both, right? And that makes sense since this is sort of covering the entire market. But if we look down here, this is really where you can see the difference between this fund and the equal-weighted fund I'll show you in a minute. This fund, let me see if I can join this. Let me try it over here. There we go. There I am. Okay. You'll notice that this fund, for every dollar you put in this fund, just under 7 cents, or maybe we'll do $100, $6.70 goes to NVIDIA because it's the largest company. $5.99 goes to Microsoft. $5.88 goes to Apple. And we don't have to go far. You go just down to Berkshire. It only gets $1.40 on a $100 investment. And if we skip and go down 10 more companies, boy, Costco only gets 64 cents. And that can strike folks as odd and maybe even wrong when they're first learning about investing in index funds. It's like, that doesn't feel right. But remember, the primary goal here is to mimic the market, and the market doesn't treat all of these companies the same, right? The market allocates more capital to companies like NVIDIA, Microsoft, and Apple than it does other companies, which, by the way, could be great companies, but like Walmart, Johnson & Johnson, and Costco. So, okay, that's the typical cap-weighted index fund. If we jump over to Invesco, you'll notice they all have roughly the same amount allocated to them, roughly, 30 cents, 30 to 35 cents. In fact, their number one company up here is Warner Brothers, right? I mean, so I don't even know if we'll find, since they're all the same. Well, there's Tesla, 27 cents. So they're not identical, but they're very close. Now, what does that mean as a practical matter? Well, this is not a large cap blend fund. Remember, the total U.S. stock fund was a large cap blend. That's what BLD stands for. This equal weighted is actually a mid cap value, right? It's just how it plays out because it's simply allocating the money in more or less equal amounts across approximately 500 companies. So is this a good approach because AI stocks are expensive? Well, let me show you one more thing before we talk about how to think through this. This is a Testfolio. It's a free tool that you can back test different portfolios. I've created one portfolio with VTI in it, one with RSP, which is the ticker for that Invesco equal weighted portfolio. And I have to be honest, I was surprised by the results. So this goes back to 2003. It stops there because one of the funds, RSP, that's all the data they have. I guess that's when the fund was launched. Look at this. Yes, VTI outperformed, and I know that number's small to read on the screen, but it's 115,000. That's based on an initial $10,000 investment. RSP, 102, 103,000. But in the chart, the red line is RSP. And look at this. It outperformed VTI all the way until COVID, starting back in 2003. And then they were kind of neck and neck. And then look, it was outperforming again all the way really until like this year or maybe sometime last year. And then they were almost dead even again earlier this year during the tariff brouhaha, I guess we'll call it, the kerfuffle, whatever. And now VTI is pulled away a little bit this year. I was really surprised to see that. So that's the data. That's, now we could look at different time periods, different starting periods. And I did that before the video, but you can use Testfolio to do that yourself. I encourage you to do it. I was surprised, though, that an equal weighted fund had done so well. But in some ways, it kind of makes sense, particularly in the first decade where we had the tech bubble bursting. Now, it had already burst when RSP was launched in 2003, but then we had '07, '08, '09. Of course, that affected the whole market, but maybe it affected larger companies more. I don't really know. But I was surprised to see that both ETFs more or less performed about the same. Now, that's an interesting question. I think that would end up helping us if AI stocks, the big companies, actually sort of cratered and went down 30 or 40%, while the rest of the S&P 500 did not. That's an important qualification. I don't know that it's actually going to play out that way. Here's my take on it. I think one should be diversified away from just a total U.S. stock fund. The way I do it is to allocate money to a small cap fund, in the U.S. small cap fund, and to allocate money to international stocks. That's what I do. Of course, I have bonds as well, and I'm comfortable with that diversification. If someone said, well, I want to just use an equal weighted ETF like the Invesco ETF, I didn't look at it at its expense ratio, which I'll do quickly because that's always important. But if someone said, yeah, I want to do that over a VTI, I can't say that's an unreasonable approach. I tend to prefer the cap weighted index funds because I think they do mimic the actual flow of capital, and I just feel more comfortable with that. But I can't argue that an equal weighted fund approach is a bad approach. Just looking at the expense ratio, yeah, it's just 0.2, a little more expensive, but still reasonable. What I would say is that whatever approach one takes, I think it's best to stick with it, regardless of valuations. Now, if you're investing in individual stocks, I would feel differently about that. But in terms of broad-based index fund investing, I've just found that trying to time the market, even when valuations are high or when they're really low, can get you into a lot of trouble. I will show you this recent article that I linked to in my newsletter recently from the blog A Wealth of Common Sense, Staying the Course Worked. And he talks about, he was looking at all the Trump stuff, the tariff stuff is what I meant to say, but I guess it was Trump, in April, and how the markets sort of tanked, but where they are now, and just how unpredictable the market is. I'll link to this article. I think it's worth reading. So, but that's my take. I don't think it's an unreasonable approach to use equal weighted index fund as a way to get diversity. But I would be cautious about moving in and out of approaches based on valuations. I think that you could time it perfectly and feel really good about yourself, but you could just as easily not time it so well. So that's my take on that. Question 4. I'm 64 and I would like to begin annual Roth conversions from my traditional IRAs. Can you review the rules surrounding these conversions in one's retirement years? I would like to know how soon I can withdraw converted funds and their associated earnings penalty-free and tax-free. That comes from a viewer named Dave. Dave, great question. So he's 64, very important. So let's imagine he does a Roth conversion. We have to think of two different rules to know when he can pull that money out, penalty and tax-free. All right. So rule number 1 is a 5-year rule that relates specifically to Roth conversions. It says, if you do a Roth conversion, now let's think about what happens. You go from a traditional IRA to a Roth IRA, that triggers taxes, right? So you've already paid your taxes on whatever amount you've converted. Now, when can you pull that money out and avoid the 10% penalty? Normally, you have to wait 5 years. That's the rule. Now, in his case, though, he doesn't. Why? Because that 5-year rule on Roth conversions doesn't apply once you reach 59 and a half. He's 64. Now, you may say, well, why is that, right? That doesn't make any sense. It kind of does. Why did the IRS implement this 5-year rule? Here's what they were trying to deal with. Imagine Dave wasn't 64. Imagine he was 54. And he wanted to pull money out of a traditional IRA. He knows he's going to have to pay his taxes. I can't avoid that. But he really wants to avoid that 10% penalty. So he thinks, I'll convert it to a Roth. Yeah, I got to pay my taxes, but I'll owe those anyway. But once it's in the Roth, can I take out my money, penalty and tax-free anytime? I've paid the taxes. I think it's penalty-free. I'll just pull the money out of the account once it's in the Roth. and then I'll avoid the 10% penalty. And the IRS said, yeah, that's clever, but we've caught on to what you want to do. So to discourage people from doing that, there you go. They said, you got to wait 5 years. Well, once you reach 59 and a half, you're not skirting around the 10% penalty rule anymore because it doesn't apply to you because you're 59 and a half or older. Dave's 64. So that's my take. When I talk about these sorts of issues, though, I always remind you, I'm not a tax expert, so you want to make sure this is right. You can even just assume that I'm wrong, although I believe that I'm right. Doesn't stop me from being wrong. Okay, what about the other 5-year rule? There is another one. The other 5-year rule deals with holding a Roth IRA for at least 5 years before you can take out earnings penalty and tax-free. Now, this 5-year rule does apply to Dave. Doesn't matter that he's 64. He could be 164. And if he opens up a Roth IRA for the first time, he's got to wait 5 years before pulling out earnings. Now, in Dave's case, I don't know how long he's had a Roth IRA. So he may have met this rule too, but let's assume he didn't. Let's say he just opened it up. And so how's that going to work? Well, remember, you can always take out contributions tax and penalty free. Now, that would be money that he wrote from his checking account, put it into a Roth IRA. That's not part of his question, but I want to point that out. What about converted money? He can pull that money out. He's already paid the taxes on it, so that's been done. He did that when he did the Roth conversion. And we've already established he doesn't have to worry about the 10% penalty because he's 64. So he can take out his converted money, penalty and tax. I'll call it tax-free. He's already paid the taxes, but penalty-free. What's left? Earnings. So can he take the earnings out, penalty and tax-free? So if he hasn't had the Roth IRA open for 5 years and he pulls out earnings, he will get taxed on them. What about the 10% penalty? My understanding is he won't get penalized the 10% penalty because he's older than 59 and a half. Now, I actually did some research on this, and I found this article from Schwab, which covers it. It has if you're 59 and a half and under, or if you're age 59 and over, and the answer is right here. So I'm reasonably confident, and I will link to this below the video. The other last thing that I'll mention is you say, well, I've got one big Roth, or I've got multiple Roths. The IRS doesn't care. They're going to treat all your Roth IRAs as one. And you say, I've got all kinds of money in there. I've got contributions I made. I've converted some money. They've earned some money. How does that work if I take out 10,000? Which one is it? And there's an ordering rule. The IRS just assumes that what you withdraw first are contributions. So if you've got $30,000 in contributions, the first $30,000 that you pull out, the IRS will say, yeah, those were all contributions you took out. It doesn't matter if you've got 8 different Roth IRAs. It doesn't matter which one you took from. It doesn't matter if it's all in one. Contributions come out first. Converted amounts come out second. And it's only after all of the contributions are out and all of the converted money are out that they then say, okay, well, you got earnings. That's the only thing that's left. So if you take more out, it's earnings. And then you've got to go through these rules to understand the consequences. And all I can say is don't shoot the messenger. I'm just doing my best to convey what the rules are. Yeah, they're complicated. Okay, question number 5. This is an easy one. You've mentioned in the past that you transitioned from a 6-fund portfolio to a simpler 3-fund setup. I'm curious, was that change mainly about reducing complexity and streamlining your investments, or did it reflect a stage of investment maturity? Oh, I like that. I think it did. A stage of investment maturity and confidence in a more minimalist approach. This is from Michael. Honestly, it was a little bit of both. I definitely wanted to simplify. And so I had a separate REIT fund. I don't have it anymore. I had a separate small emerging market fund. These were both Vanguard for what it's worth, but I don't have that anymore. I have a total U.S. stock mutual fund, total international mutual fund. These are all Vanguard, and a small cap fund. And those are all in my taxable account, or my wife and I's taxable account. And I'm very comfortable with that approach. And so some of it was streamlining. Now, I do have bonds. They're in our retirement accounts in the form of a Vanguard target date retirement fund that's got an allocation of about 70% bonds and 30% stocks. And I picked that one so that my overall allocation is roughly 70 to 75% stocks and 25% in bonds. And so I guess I have that fourth target date fund, if you will. That's why I kind of say it's, I guess, 4 funds now. But yeah, I wanted to simplify. It requires me to do much less rebalancing. I really don't do any rebalancing at this point, frankly, other than how I invest new contributions. I rebalance in that sense, but that's it. I haven't sold funds to rebalance in quite a while. The whole thing about investment maturity, I'm not sure I would use maturity. I don't know if I've matured or not. I'm trying. But anyway, it is a realization that trying to slice and dice a portfolio and have this much in value and that much in emerging markets and some REITs over here. And I concluded that could work out. And in the past, sometimes it's worked out well for me. I invested in emerging markets for the very first time in 2003. I'll let you Google how emerging markets did that year, but it was pretty sweet. But that was just luck. And what I ultimately decided was I just don't need to slice and dice my portfolio that way. Others argue that you should really focus on value and other things. And, there's some appeal to that in my mind. But I just got to the point where I said, we don't need it. We're fine. I can just simplify it. And I'm just as likely to do better than if I tried to slice and dice my portfolio with all of these sort of sub-asset classes. And so that's what I did. And I'm very happy with the outcome. And I think if something happens to me, I think my wife will be able to manage this very well, in large part because she won't have to do anything. She won't have to rebalance. She can just spend the money, So there you go. That's my take on it. Great questions as always. If you have questions or comments, leave them below the video. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.